Invesco EQQ Nasdaq 100 ETF fund of. What kind of value addition this NFO brings to your portfolio? Will this NFO fund add stability to your portfolio, volatility to your portfolio, adds return to your portfolio, or adds risk to your portfolio? Let us analyze and evaluate. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take a right financial and investment decision. Before analyzing this particular fund, let us understand what are all the key features of this particular fund. Let us understand so that it will be easy for you to evaluate this particular fund. This particular fund NFO is open till 13th April 2022. This comes as an open-ended fund. This comes as a fund of fund. Means this fund collects money and it will not directly invest in stocks or fixed income securities. No, they will not do. They will simply invest in another mutual fund, which is basically an ETF. So this comes under international equity category because they are going to invest in a US ETF. So this comes under fund of fund category, a fund which is going to invest in another ETF, which is an international category. The benchmark index for this particular fund is Nasdaq 100, and there is no entry or exit load for this fund. What is the investment objective of this particular fund? Obviously, to provide long-term capital appreciation. This fund aims to generate returns that correspond to performance of Invesco EQQ Nasdaq 100 UCITS ETF. So this is an ETF. This is not an India fund. Okay, this fund is basically a US ETF, which is investing in Nasdaq. It is already available. This is the underlying fund in which this particular fund of fund will invest. So they will generate similar return to this ETF subject to currency movements, expense ratio, and tracking error. The investment strategy of this fund is going to be very passive. They will not do any market analysis or economic analysis or financial statement analysis of the underlying stocks in Nasdaq 100 index. This ETF will simply buy the entire 100 stocks in Nasdaq in the same proportion, right? The underlying fund is basically a passive fund. They will not do any analysis on the underlying stocks. So fund management expenses are not there. They are going to simply buy the entire 100 stocks in the same proportion. The outlook of this particular index is it gives exposure to 100 largest US and international non-financial companies which are listed in Nasdaq stock market. And these Nasdaq 100 companies have strong brand equity. And they also have valuable patents. And they have a good economies of scale that will drive product demand and pricing power. Pricing power is definitely an important parameter for long-term sustainability and profitability of a company. It is definitely available in most of the Nasdaq 100 companies. To get a clarity on this particular fund, understanding the investment flow of this fund can help you. You as an investor is going to invest in Invesco EQQ Nasdaq 100 ETF fund of fund. This is an Indian fund, right? This fund collects money from you and me, and in turn they invest in Invesco EQQ Nasdaq 100 UCITS ETF. This is the underlying fund in which this particular fund is going to invest, right? It is not an Indian fund, it is an international fund. The size of the fund is US dollar 6.09 billion, right? In INR terms, it comes to 45,000 crores. Already it is 45,000 crores fund in which you are going to invest. And in fact, that international ETF will invest in 100 largest non-financial companies listed on the Nasdaq stock market based based on market capitalization, 100 largest companies in which the international ETF will invest. You are investing in fund of fund will invest in international international ETF will invest in Nasdaq 100 stocks. This is how the investment flow goes. The top 10 holdings of this particular ETF, the underlying fund, are well-known companies: Apple, Microsoft, Amazon, Tesla, Alphabet. So most of the well-known companies are there. To give you clarity on what kind of diversification this fund has got, you can check the diversification part, right? This fund has got exposure to information technology, communication services, consumer discretionary, healthcare, consumer staples, industrials, utilities. So they have exposure to all these sectors. So it is kind of diversified fund. We can't say this fund is a concentrated portfolio. No, this is reasonably diversified fund. What's the kind of performance the underlying fund in which this particular fund of fund is going to invest has delivered? What kind of returns they have delivered? Though they have delivered returns in dollar terms, for your convenience, we have converted that into INR terms, right? In the last 1 year, this particular fund has delivered 13.41% return last 1 year in INR terms. In the last 3 years, this fund has delivered 29% return. Since inception, this fund has delivered 21% return. So reasonably, this fund has delivered a good return in the past, but as you know, in mutual funds, past returns are not the benchmark. You should not consider past performance, or you should not consider only past performance. Past performance is not indicative of future returns. Last 1 year, it has delivered 13%. We can't expect similar return in future also. Market is volatile. There can be ups and downs. There will be a period of negative return, no return, low return, good return, very good return. In what combination, in what stretch it is going to come, we don't know. So this fund is in riskometer basis. This fund is definitely comes at very high risk. If you got a time frame of 7 year plus, then you can consider, if you are a short-term investor, you should avoid this fund. Having understood the basic features of this particular fund and the underlying fund, and also the outlook of the index, now is the time to analyze this particular fund of fund. Enough. When we researched this particular fund, what are all our key observations which are in favor of this fund? That we are going to list down first. Pros of investing, potential merits of this fund. Long-term investments have got better potential to give you good returns, because short-term market can be volatile. Indian markets versus Nasdaq 100, they have low correlation, right? So when you are adding another investment to your portfolio, when you are adding a fund which has got less correlation to your existing portfolio, it is good for your portfolio. That brings more stability and brings a healthy diversification to your portfolio. This fund, when you are investing in this fund in INR, this fund converts that INR into US dollars and invests. Because of that, rupee depreciation and dollar appreciation, right? That will be taken into consideration, and that will give you additional return for your portfolio. Rupee depreciation will give you additional return to this particular fund. You can take advantage of rupee depreciation from this fund. This fund is suitable for investors who's looking for US equity market exposure. If you are looking to add international funds to your portfolio, then definitely this fund can be one of the considerations you can make. This fund eliminates stock selection risk, or fund manager bias is also getting eliminated. Normally, in the actively managed fund, the fund manager will pick and choose the best stocks from the index, from the market. Whereas in the index fund, because the underlying fund is an index fund, passive fund, they are going to buy the entire index. In the Nasdaq 100, they are going to buy the entire 100 stocks in the same proportion. Fund manager is not going to do any analysis. If he does the analysis, he can make wrong judgments. Because they are going to buy the entire index, there is no wrong judgment, there is no fund manager bias, there is no stock selection risk. You are buying the entire market. Being an index fund ETF category, the expense ratio is expected to be low because it is diversified across multiple sectors. This brings better diversification to your portfolio. Being like an international fund investing in top 100 companies, this brings more stability to your portfolio. As we have analyzed what are all the potential merits of this particular fund, now is the time to look at the potential demerits. Do you want to know what are all the points which are not in favor of this fund? What is the risk involved in this fund when you invest? Let us understand. Being an equity fund, this fund is not for short-term investing. So if you have short-term money, definitely you should avoid this fund. Though this fund aims to have low expense ratio and low tracking error, the ability to maintain low expense ratio and low tracking error is yet to be tested. It is not proven. Whereas in this category, there are existing funds with low tracking error and less expense ratio. So why should we go for an untested and not proven fund when we have tested and proven funds in the market? Because these funds invest in international market, it brings geopolitical risk, macroeconomic risk. If the underlying stocks are from US, if there is some economic downfall in US, then that can impact. Generally, as an investor, when you are investing in Indian market, you are attached only to the Indian economy-based risk. Whereas now you are investing in international market, the international economy of different countries can impact the performance of this particular fund. So this adds additional risk to your portfolio. Currency risk is an additional risk brought by this fund to your portfolio. Instead of rupee depreciating, dollar appreciating, if by chance dollar depreciates and rupee appreciates, then this fund can bring a portion of negative return to your portfolio. This can impact the return. Because of the expense ratio and tracking error fees involved, this fund can underperform the benchmark index. In addition to this fund is also going to maintain close to 5% in liquid to meet the redemption request or any other liquidity requirements. So that can also pull down the performance of this particular fund compared to the index. Beating index is a different game. This fund is not able to match. The possibility of this fund matching the index return is also low. This fund will not take any proactive or course correction action during market crash or when the market is at all-time high. Generally, when the market is at all-time high, fund manager will expect a crash or correction and change the portfolio into defensive stocks. When the market is already corrected, market is down, market is expected to go up based on the analysis outlook, then the fund manager will change the stocks into growth stocks, momentum stocks, so that when the stocks fall, there will be lesser fall. When the stocks go up, there will be better recovery. So this is what the fund manager does, and they will generate alpha based on that. This is not possible by this particular fund because they have to simply buy the entire index, all the 100 stocks in the same proportion, same weightage as prescribed by the respective index. Being an index fund, this will mimic and replicate the index. They will not beat the index. The one major thing with mutual fund is when you are investing in a mutual fund, the fund manager works on behalf of you, and in turn, they generate alpha. They bring additional return to your portfolio compared to market. It is available only in actively managed fund. In index fund, they will simply mimic and replicate the index. So this fund will not beat index. This fund will not do any analysis on the underlying portfolio. Any of the stocks in the Nasdaq 100, the fund manager will do any analysis. They will simply buy the entire set of stocks. Right? They will not look at the balance sheet. They will not look at the profitability. They will not look at the sustainability. They will blindly go and buy. They will not take calculated risk. They are taking blind risk here. So even one of the stocks in the top 100, has got a very bad review, very negative outlook. It looks like they will move out of top 100. Even then, the fund manager has to buy and hold that stock in the portfolio as long as it is part of the index. So the fund manager is forced to take blind risk here. And even if he is willing, he will not be able to take calculated risk. So what is the final takeaway here? Whether this fund is good or bad? Can I buy this fund or should I avoid this fund? What should I do? It depends upon what kind of investor are you. Yes, it depends upon you. If you are a conservative investor, first choose to invest in Indian equity funds with good track record. If you are looking for global equity exposure, right, then consider existing international funds with a good track record, with low expense ratio and low tracking error instead of this particular fund. This is for if you are a conservative investor. If you are an aggressive investor, even before going to aggressive investor, I would like to add one more point here. This fund is definitely not suitable for investors who are looking for market beating returns. If you are looking for dynamic fund management, moving from large cap to mid cap to large cap, moving from one sector to other sector based on the market outlook, dynamically managing, right? That dynamic management flexibility is not available. They have to simply stick to the allocation given in the index. Obviously, it is not suitable for short-term investments. So if you are an aggressive investor, then in that case, you may choose to invest a minimum amount in this fund on an experimental basis and try. We have done a detailed analysis of this particular fund of fund NFO. Further questions related to this fund or any other investment options, feel free to book an appointment with our financial planner. The registration link for the appointment booking is available in the description of this particular video. We organize regular insightful investment webinars. If you are someone who would like to learn the investment strategies for long-term wealth creation, we have an upcoming webinar scheduled. You can click the link in the description box and register, book your seat for the next free webinar. If you're not subscribed to our YouTube channel so far, please subscribe now. Bye.